What if everything you think you know about investing is completely wrong? What if the smartest analysts on Wall Street, the ones in designer suits managing billions of dollars, are no better at picking winning stocks than a blindfolded monkey throwing darts at a newspaper? That sounds crazy, right? But here's the thing. The data says it's true. Study after study, decade after decade, shows that the vast majority of professional fund managers cannot consistently beat the market. And yet, millions of people every single year hand over their savings, their retirement funds, their futures, trusting that someone smarter than them has all the answers. Today, we're diving deep into one of the most important investing books ever written. A book that changed the way the world thinks about money. A book that Wall Street absolutely hates. This is the full breakdown of A Random Walk Down Wall Street by Burton G. Malkiel. Now, before we get into the ideas, let me tell you who Burton Malkiel is, because this is not some guy with a podcast and a theory. Malkiel is a Princeton University economist, a former member of the President's Council of Economic Advisors, and a board member of multiple investment funds. He has spent decades studying financial markets at the highest academic and practical levels. This book was first published in 1973, and it has been updated and reprinted 12 times since, because the core message has only become more true with every passing year. He's not selling you a get-rich-quick scheme. He is not promising secret formulas. What Malkiel is doing, patiently, brilliantly, and with overwhelming evidence, is tearing down almost everything the financial industry wants you to believe. And then he hands you something far more powerful. Something so simple, it's almost offensive. So what exactly is a random walk? Imagine you're watching a drunk man stumble home from a bar. He knows the general direction of his house, but every step he takes could go left, right, forward, or backward. His path is completely unpredictable from one moment to the next. You can watch him for hours, you can study his patterns, you can hire the world's best statisticians, and none of it will tell you where his next step goes. Malkiel says stock prices move the same way. Every day, every hour, every minute, stock prices make random movements that cannot be predicted from past behavior. And this isn't just a philosophical argument. It's backed by mountains of data. Researchers have looked at decades of stock prices and found that past price movements have virtually no statistical power to predict future movements. But here's where it gets really interesting. Because this random walk idea isn't just a curiosity, it has enormous consequences for how you should manage your money. If stock prices truly move randomly, then technical analysis, the art of reading charts, spotting patterns, following trends, is essentially worthless. And if that's true, then billions of dollars spent on stock analysts, trading algorithms, and financial advisors might be one of the greatest financial illusions in modern history. Let's talk about technical analysis first, because this is the one that trips up the most everyday investors. You've probably seen it. Someone pulls up a stock chart and starts drawing lines. Head and shoulders patterns. Support levels. Resistance zones. Moving averages. Double tops, double bottoms, candlestick formations. It looks so scientific. So precise. It feels like you're finally cracking the code. Here's the problem. Malkiel looked at all of it and found that none of it reliably works. When researchers strip away the hindsight bias and test these patterns on fresh data, they fail. They fail consistently. The patterns that look so obvious in the rearview mirror disappear completely when you try to use them in real time. Malkiel ran a fascinating experiment. He had students flip coins and plotted the results as if they were stock price movements. Heads meant the price went up, tails meant it went down. When he showed these randomly generated charts to professional technical analysts, They got excited. They saw patterns. They identified trends. They made bold predictions about where the price would go next. The charts looked completely real to them, but they were pure random noise. Completely meaningless. That should give you pause. Because if professional, trained analysts cannot tell the difference between real market data and random coin flips, what does that tell you about the value of everything they're selling? Now here's the thing. Malkiel isn't dismissing chart reading out of jealousy or arrogance. He's looking at the empirical record. And the empirical record is devastating. Studies have shown that trading systems based on technical analysis, once transaction costs are accounted for, consistently underperform a simple strategy of buying and holding a broad market index. Consistently. Not sometimes. Consistently. Alright, so technical analysis is out. But what about fundamental analysis? What about the serious, suit and tie approach of reading annual reports, studying balance sheets, calculating price-to-earnings ratios, and projecting future earnings growth? Surely that must work, right? Surely that's real analysis? Malkiel has much more respect for fundamental analysis. It's intellectually serious. It's grounded in actual business performance. And yes, in theory, understanding a company's true value should help you identify when it's underpriced or overpriced. That logic is sound. The problem is not the logic. The problem is everything else. First problem, information. In an efficient market, by the time any piece of public information reaches you, it has already been processed by thousands of analysts, traders, and algorithms. The moment a company releases its earnings report, that information is absorbed into the stock price within milliseconds. You are not getting there first. You are never getting there first. The market is already ahead of you. Second problem, forecasting is brutally hard. Malkiel digs deep into the research on earnings forecasts by professional Wall Street analysts, the people paid millions of dollars to predict where companies are going. And the results are humbling. Their forecasts are wrong more often than they're right. Their errors are large. And their ability to predict future earnings growth is barely better than chance. Even the best analysts at the best firms, with access to company management and mountains of data, consistently miss. And here's why. Companies are extraordinarily complex organisms operating inside an unpredictable world. A new technology emerges and disrupts an entire industry. A pandemic shuts down the global economy. A competitor makes a brilliant move nobody saw coming. A regulation changes overnight. These events are not predictable. And because they're not predictable, future earnings are not predictable. And if future earnings aren't predictable, then the intrinsic value of a stock isn't really knowable with precision, even with brilliant analysis. There are exceptions, of course. Warren Buffett exists. Charlie Munger exists. Peter Lynch exists. But Malkiel makes a critical point here that most people overlook. When you have millions of investors all trying to do the same thing, a small number will succeed through pure chance alone. If 1 million people each flip a coin 10 times, some of them will get 10 heads in a row. Does that mean they're skilled coin flippers? It means they're lucky. The question is never whether successful investors exist. The question is whether their success can be attributed to skill or luck. And distinguishing between the two is almost impossible until decades have passed. Now we arrive at the intellectual heart of the book, the efficient market hypothesis. This is the theory that ties everything together. And once you truly understand it, you will never look at the stock market the same way again. The efficient market hypothesis says this: at any given moment, the price of a stock reflects all available information about that stock. Everything that is publicly known, Every earnings report, every analyst opinion, every news article, every rumor has already been factored into the price. The market is, in a sense, always right. Not because it's perfect, but because it's the collective judgment of millions of buyers and sellers, all acting on everything they know. Think about that for a second. If a stock is truly fairly priced at all times, based on all available information, then there is no consistently profitable way to pick individual stocks. Because any piece of information you could use to identify a bargain is already baked into the price. You're not smarter than the market. Nobody is consistently smarter than the market. There are three versions of the image: weak, semi-strong, and strong. The weak form says past prices can't predict future prices. That directly kills technical analysis. The semi-strong form says all publicly available information is already in the price, killing most forms of fundamental analysis too. The strong form says even private insider information is priced in, which is more controversial and likely not completely true. But the weak and semi-strong versions have enormous empirical support. Now, and this is important, Malkiel is not saying markets are perfectly efficient. Markets can become irrational. Prices can deviate from fair value. Bubbles can form. Crashes can happen. He's saying that markets are efficient enough, often enough, that trying to systematically exploit inefficiencies is extraordinarily difficult and expensive. After you pay transaction costs, taxes, and management fees, the edge disappears for almost everyone. And here's the kicker. Even if you were brilliant enough to identify a mispriced stock, which is already incredibly hard, you'd need to identify it before the rest of the market does. Before the algorithms. Before the hedge funds, before the high-frequency traders executing thousands of transactions per second. That is not a fair fight. That is a game the individual investor simply cannot win consistently. But here's where the story gets darker and more human, because Malkiel doesn't pretend markets are always rational, cold calculating machines. He spends a fascinating section of the book documenting one of the most important and recurring phenomena in financial history, the speculative bubble. A speculative bubble happens when asset prices rise far above any rational measure of value, driven purely by the belief that prices will keep rising. It's a collective delusion, a self-reinforcing madness. And the terrifying thing is, it happens over and over again, in every generation, in every country, in every market. Malkiel walks through some of history's most spectacular bubbles. In the 1600s, Dutch tulip mania gripped an entire nation. Tulip bulbs, actual flower bulbs, were selling for prices equivalent to a luxury house. People were trading their life savings for a single bulb. Rare varieties were worth more than skilled craftsmen earned in an entire year. And then, as all bubbles do, it collapsed. Overnight, tulip prices fell 99%. Fortunes vanished. Then came the South Sea bubble in early 18th century England. A company with almost no real business saw its stock price rise over 800% in a matter of months, fueled by wild rumors and royal endorsements. Isaac Newton himself, arguably the greatest scientific mind in history, lost a fortune in it. He reportedly said, "I can calculate the motion of the stars, but not the madness of men." And then there was the 1920s American stock market. Ordinary people borrowing money on margin to buy stocks, convinced the market could only go up. Radio stocks trading at hundreds of times their earnings. Taxi drivers giving stock tips. Shoeshine boys discussing portfolios. And then 1929 arrived. The market crashed. The depression followed. Millions were ruined. Malkiel then brings this history painfully close to home. The 1990s dot-com bubble. Companies with no revenue, no profit, sometimes no actual product, trading at astronomical valuations because they had .com in their name. Everyone knew it was irrational. Smart people said it was irrational. And yet the buying continued because the prices kept going up and nobody wanted to miss out. Until March 2000, when the Nasdaq fell nearly 80%. 80%. And then 2008. The housing bubble. Mortgages handed out to people who couldn't afford them, packaged up into complex financial instruments nobody fully understood, and sold around the world as if they were perfectly safe. Until they weren't. The entire global financial system nearly collapsed. What do all these bubbles have in common? Human psychology. Specifically, 3 deeply wired instincts that serve us well in most areas of life but destroy us in financial markets. First, herd behavior. When everyone around you is buying something and getting rich, it feels irrational not to join. Our brains are wired to follow the crowd. In evolutionary terms, if everyone is running from something, you'd better run too. But in markets, following the herd at the wrong moment means buying at the peak, right before the crash. Second, overconfidence. Studies consistently show that humans dramatically overestimate their own skill and knowledge. We remember our winning trades vividly. We forget our losses or attribute them to bad luck. This selective memory creates a false sense of competence. We think we're good at this. We're almost never as good at this as we think. Third, loss aversion. Psychologists Daniel Kahneman and Amos Tversky showed that the pain of losing $100 is psychologically about twice as powerful as the pleasure of gaining $100. We hate losses more than we love gains. And this causes us to do irrational things, like holding on to losing investments far too long, hoping they'll come back, while selling winning investments too early to lock in the good feeling. Exactly the opposite of what rational investing requires. Now at this point, the behavioral finance researchers, and there are brilliant ones, would push back on Malkiel. They say, look, human psychology creates consistent, predictable biases in how people invest. And where there are consistent biases, there are consistent pricing errors. And where there are consistent pricing errors, there are opportunities. Malkiel acknowledges this. He spends real time with behavioral finance concepts, and he doesn't dismiss them. Things like momentum, the tendency for recent winners to keep winning and recent losers to keep losing, at least for a while. Things like value effects, the tendency for out-of-favor, cheap-looking stocks to outperform over long periods. These are real phenomena with real data behind them. But here's Malkiel's counterpoint, and it's powerful. Even if these patterns are real, they are not easily exploitable by ordinary investors. By the time a pattern becomes widely known, arbitrageurs and hedge funds trade against it until it disappears or shrinks. The patterns also involve enormous risk during the periods when they don't work. And by the time you add transaction costs and taxes, most behavioral-based strategies end up delivering mediocre returns for ordinary people. His conclusion is nuanced but firm. Markets are not perfectly efficient, but they are efficient enough that trying to beat them, for most people, most of the time, is a losing strategy. The costs of trying to beat the market are real and certain. The benefits are uncertain and elusive. So what should you actually do with your money? This is where Malkiel shifts from diagnosis to prescription. And his answer has become one of the most influential ideas in the history of personal finance. Buy index funds. Hold them forever. And stop trying to be clever. An index fund is a fund that simply owns a slice of every company in a market index, like the S&P 500, which tracks the 500 largest American companies. It doesn't pick stocks. It doesn't have a manager trying to outsmart the market. It just buys everything and holds it, passively, quietly, at extremely low cost. And the results are extraordinary. Over virtually every long time period studied, broadly diversified index funds outperform the majority of actively managed funds. Not some of the time, not half the time, the majority of the time. And over very long periods, 20, 30, 40 years, the outperformance becomes overwhelming. But because of costs. When you invest in an actively managed fund, you pay management fees, trading costs, marketing fees, and often sales commissions. A typical actively managed fund might charge 1% per year in fees. An index fund charges as little as 0.03%. That sounds like a tiny difference. It is not a tiny difference. Let's do the math, because this is where it gets genuinely shocking. Imagine two investors. Both start with $10,000. Both earn the market return of, say, 8% per year before fees. One invests in an index fund charging 0.1% per year. The other invests in an actively managed fund charging 1.5% per year. After 40 years, the index fund investor has roughly $200,000. The actively managed fund investor has roughly $120,000. The fee difference has cost them $80,000. On a $10,000 initial investment. That is the power, or rather the devastation, of fees. And remember, that assumes the actively managed fund matches the market return before fees. Most don't. Most underperform before fees too. So the real gap is often even larger. Malkiel points to the research on mutual fund performance, which shows something deeply uncomfortable for the fund industry. Past performance does not predict future performance. The funds that top the charts in any given year tend to revert to average, or worse, in the following years. Chasing past winners is one of the most reliable ways to underperform. When Malkiel first proposed index investing in 1973, Wall Street laughed at him. Bogle's folly, they called it, after John Bogle, who founded Vanguard and launched the first retail index fund in 1976. Nobody wanted it. Why settle for average when you could try for the best? Today, index funds hold trillions of dollars, and that initial ridicule looks like one of the most embarrassing misjudgments in financial history. Now, buying index funds isn't the only thing Malkiel teaches. He also offers a remarkably practical guide to building real wealth over a lifetime. And it comes down to a handful of principles that are simple to understand but surprisingly hard to actually follow. Principle 1. Start early and let compounding do the work. This one cannot be emphasized enough. The mathematics of compound growth are almost unbelievable until you see them. A single dollar invested at 8% per year becomes $7 after 25 years. After 50 years, it becomes $47. From $1. Without adding anything. The difference between starting at 25 and starting at 35 is not 10 years of growth. It is a completely different financial life. Principle 2. Invest regularly, regardless of what the market is doing. This is called dollar cost averaging. Every month or every paycheck, you invest a fixed amount, whether the market is up, down, or sideways. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more. Over time, this mechanical discipline actually works in your favor, and it removes the emotional anguish of trying to time the market. Principle 3. Never try to time the market. This is the one that trips up even sophisticated investors. The temptation is always there. The market feels overvalued. A recession seems imminent. You want to get out before the crash and get back in at the bottom. It sounds so sensible. But study after study shows that market timing fails. The market's best days tend to cluster around its worst days. If you miss just the 10 best trading days in a decade, your returns can be cut in half. Nobody, and Malkiel means nobody, can consistently predict those 10 days. So you stay in, boys. Principle 4. Diversify broadly. Don't put all your money in one stock, one sector, one country, or even one asset class. Own stocks across different industries and geographies. Hold some bonds as you get older. Diversification is the only free lunch in investing. It reduces risk without necessarily reducing expected return. Principle 5. Match your risk to your timeline. A 25-year-old with 40 years until retirement can hold mostly stocks and ride out crashes with patience. A 60-year-old who needs the money in 5 years cannot afford a 50% market drop. As you age, gradually shift toward more stable investments. The key word is gradually, not panicked selling at the bottom of a crash. Principle 6. Minimize taxes and costs. Every dollar you pay in fees and taxes is a dollar that isn't compounding for your future. Use tax-advantaged accounts like 401(k), and IRAs whenever possible. Choose low-cost index funds. Avoid excessive trading, which generates taxable gains. The boring, unsexy work of minimizing friction is one of the highest return activities in investing. Now let's talk about something that gets lost in a lot of investing discussions: risk. Because Malkiel's message is not simply buy stocks and everything will be fine. It's more nuanced than that. And understanding risk is fundamental to understanding why his strategy works. In finance, risk and return are inseparable. If you want higher expected returns, you must accept higher risk. Full stop. There is no asset that offers high returns with zero risk. If someone claims to have found one, run. It's either a fraud or a misunderstanding. The stock market offers higher long-term returns than bonds or cash precisely because it is riskier. Stocks can fall 20%, 30%, 50% in a bad year. They did in 1929. They did in 2002. They did in 2008. They will again. That volatility, that gut-wrenching uncertainty, is not a bug. It is the price of admission for higher long-term returns. The investors who earn those returns are the ones who can stomach the volatility and stay invested. Malkiel emphasizes a crucial point. There are two types of risk in stocks: systematic risk and unsystematic risk. Systematic risk is the risk of the entire market moving against you. A recession, a financial crisis, a global pandemic. This risk cannot be diversified away. You can't escape it by owning more stocks. It is the fundamental risk of participating in the economy. Unsystematic risk is the risk specific to a single company. A bad CEO, a product recall, a lawsuit, a competitor that eats their lunch. This risk can be diversified away. If you own 500 companies, one company going bankrupt is barely a footnote. But if you own just 5 stocks and one of them collapses, your retirement could collapse with it. This is why Malkiel is so emphatic about diversification. By owning a broad index, you eliminate all unsystematic risk for free. You are left only with the unavoidable market risk, the risk that comes with participating in economic growth. And that risk over long time periods has been well rewarded. Over most 30-year rolling periods in history, a diversified portfolio of stocks has delivered positive real returns. Not every year, but over decades. Malkiel doesn't stop at stocks. He walks through several other asset classes and what role they should play in a well-constructed portfolio. Bonds are the traditional counterweight to stocks. When stock markets fall, high-quality bonds often rise, or at least fall less. As investors get older, shifting more of their portfolio toward bonds provides stability and income. Malkiel recommends a rough rule of thumb: your age in bonds. If you're 40, hold roughly 40% in bonds. If you're 60, 60%. This is a starting point, not a rigid rule. Your personal situation matters enormously. Real estate is another asset class Malkiel takes seriously. Owning your own home has historically been a good wealth-building strategy, not because house prices always rise dramatically, but because a mortgage forces disciplined saving, provides leverage, and delivers tax advantages. He's more cautious about real estate as speculation, buying properties to flip, or betting on rising prices in a hot market. That's just another form of the same market timing game that fails in stocks, applied to a less liquid, higher-cost asset. He also covers REITs, real estate investment trusts, which allow ordinary investors to own a diversified portfolio of commercial real estate without the hassle of being a landlord. These can provide income and diversification in a portfolio as long as they're held for the long term and purchased at reasonable valuations. Here's what I find most profound about this book. It's not really just about investing. It's about the nature of knowledge, humility, and the gap between what humans think they can predict and what they actually can predict. We live in a world that rewards complexity, that glorifies expertise, that pays enormous fees to people who project confidence and authority about uncertain futures. In investing, in medicine, in business, in politics, the confident expert with a complicated model is always more appealing than the humble person who says, "I don't know, but here's a simple, reliable approach." Malkiel's book is a sustained argument for simplicity over complexity, for patience over activity, for discipline over excitement. And these are virtues that go far beyond investing. Think about how this applies to your own financial behavior. Most of us check our portfolios too often. We react to headlines. We feel the urge to do something, to buy, to sell, to adjust, when the rational choice is often to do nothing. The investor who checks their portfolio daily is almost certain to make worse decisions than the investor who checks it once a year. Because daily checking amplifies fear and greed. It makes noise look like signal. It turns long-term investing into short-term gambling. There's a beautiful irony here. The investor who appears lazy, who buys a broad index fund, sets up automatic monthly contributions, and then largely ignores their portfolio for decades, will almost certainly outperform the investor who works incredibly hard, reads every financial report, watches every market update, and makes constant adjustments. Hard work in investing, beyond a certain point, actually makes you worse. Not better, worse. Sounds simple. Almost nobody does it. But because human psychology fights it every step of the way. We're wired for action. We hate feeling passive. We crave stories about why this company will win, why this market will crash, why now is different from before. The financial media feeds these cravings every single day with urgency and drama. Breaking news, market alerts, expert predictions. Buy this, sell that, rotate into this, hedge with that. All of it designed to keep you engaged, keep you clicking, keep you trading. Because your engagement and your trading is how they make money, not you. So let me bring this all together into the clearest possible picture of what Malkiel is actually recommending, because this is the actionable heart of everything. Step 1. Invest in low-cost, broadly diversified index funds. An S&P 500 index fund covers 500 of America's largest companies. A total world index fund extends that globally. These two funds, combined in some ratio, give you ownership of thousands of companies across every major economy on Earth. That is extraordinary diversification at minimal cost. Step 2. Invest consistently. Set up automatic contributions from every paycheck. Don't wait for the right moment. There is never a perfect moment. Just invest regularly in good times and bad, and let dollar-cost averaging work in your favor. Step 3. Hold bonds appropriate to your age and risk tolerance. Bonds reduce volatility. They may not be thrilling, but they allow you to sleep at night, and staying invested through market crashes is far easier when your entire portfolio isn't in stocks. Step 4. Rebalance annually. If stocks have risen dramatically and now represent more of your portfolio than you intended, sell a small amount and shift it toward bonds or international stocks. This is not market timing. This is maintenance. Like rotating your tires. It keeps the machine running the way it was designed. Step 5. Ignore the noise. Turn off the financial news channels. Stop reading predictions. Stop watching what the market did today, this week, this month. Your investing horizon is decades long. Short-term market movements are irrelevant noise. Treat them that way. Step 6. Stay the course. This is the hardest one. When the market drops 30%, every instinct in your body will scream at you to sell. When a hot new investment category is making everyone rich, every instinct will scream at you to buy. Ignore both screams. Reread Malkiel. Remember the tulips. Remember the dot-coms. Remember that this time is never different. We started this video with a question. What if everything you know about investing is wrong? After more than 50 years of evidence, the answer is uncomfortable but liberating. For most people, most of what the financial industry has sold them about investing is, at best, unhelpful. At worst, it has cost them tens of thousands of dollars and immeasurable stress. The truth that Malkiel has been telling since 1973 is this: the stock market is a random walk. Nobody knows where it's going tomorrow, next month, or next year. Not the analysts, not the fund managers, not the commentators, not the algorithms. Nobody. But here's the beautiful part. You don't need to know. That's the whole point. You don't need to predict the future to build wealth. You just need to own the whole market, keep your costs low, invest consistently, and wait long enough for compounding to do its extraordinary work. The tortoise beats the hare. The boring investor beats the clever one. The person who does almost nothing outperforms the person who does almost everything. It is one of the great ironies of modern finance, and Malkiel has been proving it year after year, edition after edition, for half a century. So the next time someone tells you they have a system, a strategy, a hot tip, a special insight, remember the drunk man stumbling home. Remember Isaac Newton losing his fortune. Remember that the smartest, most experienced professionals in the world, with every possible advantage, cannot consistently beat a simple index fund. And then do the boring thing, the patient thing, the simple thing, because in investing, boring usually wins. If this video changed the way you think about money even slightly, that's everything. Share it with someone who needs it, because the greatest financial gift you can give someone is not a hot stock tip. It's the truth.